Let's break it down. Hey everyone, welcome back to Entrepreneurial Edge. Today, we're talking about how your money can make more money through dividends. When you buy a stock, you become a part owner of a company. If the company does well, it may share profits with you as dividends, real cash, right into your account. This isn't a get-rich-quick scheme. It's about owning a piece of a solid business. Many companies pay dividends every quarter, rewarding you for being an owner. Dividends are a way to get paid while holding your investment, creating a steady income stream. Unlike waiting for stock prices to rise, dividends provide predictable income you can use or reinvest. Think of it like owning a rental property, but without the hassle. Your asset generates income for you. This is a proven strategy for building long-term wealth. It's not about chasing risky stocks, but about being a part owner in great businesses and sharing in their success. Anyone can learn this practical approach to growing wealth. Let's see how much income you can actually make. All right, let's get down to the numbers. Say you have $20,000 to invest. How much can you earn in dividends? It depends on the dividend yield, a percentage showing how much a company pays in dividends relative to its stock price. For example, a $100 stock paying $3 in dividends has a 3% yield. If you invest $20,000 in stocks with a 2% yield, you'd earn $400 a year. At 3%, that's $600. At 4%, $800. This is passive income, money working for you, not the other way around. Be cautious of stocks with very high yields. They can signal trouble and risk of dividend cuts. A sustainable yield for quality companies is usually between 2% and 5%. So with $20,000, you can realistically expect $400 to $1,000 a year in dividends. That's extra money for your budget or to reinvest for more growth. The key is to start and let your money work for you. Even a few $100s in dividends is proof you're building wealth. Next, let's see how reinvesting those dividends can supercharge your results. Now for the magic, compounding. When you reinvest your dividends, you use them to buy more shares, which then earn more dividends. For example, $20,000 at a 4% yield gives you $800 in dividends the first year. Reinvest that, and next year you're earning dividends on $20,800, not just $20,000. Over time, this snowballs. Your earnings generate more earnings. After 20 years, reinvesting dividends and modest growth can turn $20,000 into over $90,000. That's the power of compounding. Your money grows faster the longer you let it work. Even small amounts add up dramatically over time. The earlier you start, the more time your money has to grow. Compounding is how ordinary investors build extraordinary wealth. Don't underestimate the impact of reinvesting. Give your money time and let compounding do the heavy lifting. But remember, not all dividend stocks are created equal. High yields can be tempting, but quality matters most. A very high yield often means a company is struggling and may cut its dividend. Instead, look for companies with a long history of paying and increasing dividends. These are often called dividend aristocrats or dividend kings. They're stable, profitable, and committed to rewarding shareholders. Think of brands you use every day: consumer staples, healthcare, utilities. Their steady demand leads to reliable earnings and dividends. Focus on companies with strong financials and a track record of smart decisions. A solid 3% dividend from a quality company is better than a risky 9% from a shaky one. Building wealth is a marathon. Choose durable businesses for the long run. Do your homework and prioritize quality over yield. This approach protects your investment and helps you finish strong. Now, let's talk about building a smart, diversified portfolio. Ready to get started? Here's how to build your plan. Don't put all your eggs in one basket. Diversify across several quality dividend stocks. Spread your $20,000 across 5 to 10 companies in different sectors, like healthcare, utilities, and tech. This protects you if one stock or industry has a bad year. Not sure about picking stocks? Consider a dividend-focused ETF for instant diversification. Remember, dividend income is taxable. Know your tax situation and consider tax-advantaged accounts like a Roth IRA. Watch out for fees even if they're small. They add up over time. Check your investments once or twice a year to make sure they're still solid. Your $20,000 is a powerful start to building long-term wealth and passive income. Stay consistent, keep learning, and be patient. You're taking control of your financial future. Congratulations! If you found this helpful, check out more on our Entrepreneurial Edge channel. Don't forget to like and subscribe for more tips.